Hello YouTube. I think this is the first time I'm releasing 2 videos in one day. I've been talking about dividend growth investing, and I was kind of lucky to get this tracker from a fellow YouTuber. Uh, Forgotten the name of his channel actually, but he's quite big on dividend growth investing as well, and he created a dividend tracker which I've kind of modified to suit my needs. A good chunk of it's still pretty much his. All this setup from there to add the annual income, that's basically his setup. And he had, I think it was like a pie chart or something as well, which is pretty good. It tells you, yeah, so that's pretty good, and it works pretty well with the pie chart. So what I'll do, I can put his link in the description, and you can go check out his channel basically. Yeah, so this is my dividends, my F.I.R.E portfolio basically, which is my dividend growth portfolio, and it just focuses on, at some point in my life I'm gonna have passive income, maybe when I'm like 50. So the aim, if you look at trading T12 with this portfolio, essentially is kind of estimating that I get I think an 18 or 19% annual increase every year. So based on that, me putting in about £300 every month, I should be getting to 1 point something million in 20 years. If that's right or wrong, I don't know. If I can get up to half of that, I think I'll be okay. To be honest with you. So you've seen a lot of colors here. Essentially, the ones in green are basically the companies I'm pretty much happy to own for the next 20 years, essentially, just because of the way I've looked at their dividend growth, which I'll talk about later. The ones in yellow are ones I'm not too sure about for one reason or the other, but I'm still owning them just because, just because they basically grow their dividends on a monthly basis. Some are more consistent than others, so they're different criteria essentially. But all in all, I've got about I've got 24 stocks and one ETF. I wasn't too sure how to actually put ETFs in here and how to capture ETFs in this, so I just kind of left it basically. I kind of find it hard to get information about ETFs, so I'll just be focused on the 24 stocks. If you're interested, the ETF is the Invesco S&P 500 high dividend low volatility. That just gives me exposure to the American market basically, because most of my shares or stocks are UK stocks, and I've got a few EU stocks here as well, like SAP. I think that's Schneider Electric, and I think there's one more. Maybe I've removed that one. Oh, that was Siemens, but I've taken that one out. I think Siemens might be one I just kind of buy on its own. I'm not included in the portfolio. So what we got here, we got Ashton Group, we got Avon Rubber, we got B&M, European Valley Retail, we got Diageo, we got Games Workshop, we got GlaxoSmithKline, we got Halma, HomeServe, Intertech, I believe, to be honest with you, I think is probably the best. According to my analysis, it's basically the best dividend growth stock you can buy right now from the UK. That's according to my analysis anyways, and you see why. So Johnson and Johnson, Johnson Matey is basically a defense stock. It's not a dividend growth stock, but they do grow the dividends. Essentially, but it's not that great. I think you have to say it's 5%, and they haven't done that consecutively for a real time. Polymetal International, you got RELX, don't know how to say that. Rio Tinto, if you're looking for what's it called, a stock that has a good annual dividend. I think it was probably the one I found that had the best annual dividend out of all the UK stocks I looked at. Where you be getting about £3, £3 a year basically. So that's pretty good. I've not seen any UK stock that pays more than that. So to be honest with you, for my analysis, and Intertech pays £1 a year, and Game Workshop pays almost approximately £2 basically. But I don't know. I don't think they can maintain this, to be honest with you. But yeah, because if they do have a bad year, I'm pretty sure they're gonna cut the dividends. But yeah, we'll go through it anyway. So we've got Safe Store Holdings. We got Smith and Nephew again. We got Unilever. Unilever is also a pretty good one. They don't grow their dividend by much, but it's very consistent, and it's on average it's actually okay. I think it's about, what is it? Average about 10%. And then again, these are my figures, right? What I noticed is a lot of these figures change depending on where you get your information from. So when I was getting my information from Dividend Max, from Router, from Yahoo Finance, and a lot of the figures were actually different, to be honest with you. So I don't know if they're correct or wrong, but yeah, essentially just don't take this, for what it is. Go get your own figures and do your analysis your own self. I kind of got tired of cross-checking everything, but I'm happy with what I got anyways. SAP, then we got Schneider Electric, we got Softcat, ICMAR Pharmaceuticals, London Stock Exchange. The value for this, the PE is very ridiculous, mate. Which is why this is yellow. It's really high. But it's one of those stocks again that is a good dividend growth stock, but the PE is high. So you got DCC and we got the Sage Group. So let's see. So currently, this will not be as of today, so as of yesterday, my portfolio was valued at around £900 essentially. This figure here is just for some extra analysis, just to find out how much on average, but it doesn't really mean anything. Then you got a yield, so I'm basically yielding about 2.28%, which is quite low for some people, but if you take into consideration dividend growth, which I'll kind of show you a bit later, then you see how it works essentially. So then you have manual income. So this year I probably won't be making £20, to be honest with you, but what would happen is I will, because I've missed some of these payments already, because some of them were earlier in the year, but for next year essentially this would be more accurate. For tracking stuff that I will get paid, we've got this essentially, and as you can see, I am getting paid pretty much every month. So that's actually every month. What's the worst month? I think there's one month I've only got one. Yeah, so November would be probably the lowest paying month, but essentially I didn't plan for this to be honest. But while I was generating the list, I was hoping that it would cover every single month of the year, and lucky for me it does. So essentially it's every month income portfolio. The problem with UK stocks is basically they don't pay quarterly. They all pay either biannually or once a year. So you kind of need to get quite a few of them, or the right ones, to kind of spread across the whole year. I got quite a few, so that's why I'm able to do it this way. But if everything goes well, I should be getting a good source of passive income essentially from this in the next 20 years. So I kind of did like a little risk analysis here. I'm just gonna share it with you. To actually, before I do that, I'll just kind of go into the dividend growth side of things. So what I've done, I've taken the average um, of the stocks I have here in terms of the dividend growth over the last 3 years, and we're getting about 16%. So I've kind of so basically I've kind of, so right now the average for my annual dividends is 80 pence, right? So I kind of applied 16% to each one essentially. I just assumed if there was a dividend growth of 16% every year, what I'll be getting at the end of 20 years. And it looks like I'll be getting £15 a year. So that looked very unrealistic to me. I can't imagine someone paying, I don't know of any stock in the world that's paying £15 a year, £15 per share in terms of dividends. So I took it down to, what was this? I think it's about 5% or something. Yeah, it's about 5%, and did a dividend growth of 5% over the course of every year. So this is without I guess reinvesting or anything like that. It's just basically down to dividend growth. Dividend increases of 5% every year. And after about 20 years, I should be getting on average anyways, a dividend of about £2 per share. That's still kind of like a conservative value. So I guess the sweet spot would kind of be like around 10%, which I do believe is actually achievable. I've not done one for 10%, but there's no point. I think you kind of get the idea that over the years we just that's the whole point of dividend growth investing essentially. You basically, I've not calculated the return essentially, but it's very slow, but it's safe and it's consistent if you choose the right companies. And you serve you as a good source of passive income over the years when you get older. So I've taken some criteria here essentially to assess the stocks. So dividend cover, you got CADI. I've actually forgotten what that means actually. You've got the 3-year dividend increase. This is consecutive annual dividend increase. That's what that is. So yeah, how many times they've consecutively increased your dividend since 2020 or 2011, and this basically just has 3-year dividend increase. I think this was got from Reuters. They just understand if the company has good cash flow or not. Essentially, you'd want the company to have a positive cash flow, because it kind of means they basically have money to spare essentially, and that could be you put towards increasing dividends and all that. They also want to look at the payout ratio. So I basically assign colors like reds, yellows, and greens just to help me. And I've said reds. So I've assigned reds a value of 3, yellow a value of 2, and green a value of 1 essentially. And then I basically use that to assess the dividend growth risk in terms of them slashing the dividends, or not growing the dividends, or reducing slashing, not growing the dividends, or stopping the dividends altogether. So from that perspective, the one that stood out the most, which would pretty much make sense, because it kind of has a pretty high dividend payout, or a dividend annual dividend. and reasonably higher yield as well. So that kind of stood out as admirable by getting a score of 108 essentially. Should now be three times 3 times 2 times 3 times 2, which would give you, I think that's what it is, yeah, 3 times 3 times 2 times 3 times 2, which would give you like 108. So anything above a score of 72 essentially is very risky. Anything that's between 1 to 4 is pretty safe. Anything that's between 5 to 24 is relatively safe. Couldn't find another explanation for that one. And anything that's between 24 to 27 is risky. 24 to 72 is risky. And yeah, as I said, anything above 72 is very risky, which is the red. So most of the stocks are pretty much, I'm happy with them. Ashtead Group is basically a 1. Actually, no, that needs to be correct. Does that need to be corrected? Yeah, actually, Ashtead Group is basically a 1 because everything's pretty green. So I shouldn't be. Well, according to this, basically, I wouldn't be expecting any issues with Ashtead Group actually maintaining their dividend payouts, and also stopping them from increasing their dividends over the course of the year. And they have a pretty good dividend increase. I mean, 14%. The highest dividend increase I've seen is Avon. Yeah. However, at the moment they're cash flowing negative. I think that might be due to to the impact of COVID-19 or something like that. I mean, it's a defense stock. But Avon rubber actually, not Avon the actual body cream. But it's still got a pretty good dividend growth risk number, so that's relatively safe. So yeah, I think the second one was quite surprising actually, which was GSK, and the thing is sometimes this might be a bit misleading. So yeah, 1.4. I'm usually looking for a dividend cover that's greater than 1.1. So GSK has a 1.4, which according to my analysis, essentially, if it's less than 1.5, then it's a red. I mean, the thing is, GSK they haven't really grown the dividends at all in like the past couple of years, and the truth be told, I'm happy with them paying this 80 pence annual dividend on a consistent basis, and it's something I believe they'll be able to do over and over again. So and obviously they're pretty good value as well. They have a PE of 14 essentially. So as I said, consistently paid ATP, and I'm happy with that. And it kind of gives a little buffer as well in terms of my average dividend yield, because I was looking for something between the 2 and 3% average yield for my portfolio, so that's fine. HomeServe is pretty good as well. No, not HomeServe actually. Halma. So Halma is a really good one. Halma basically got a really good cover. Actually, before I go to Halma, I'll probably do Diageo. Diageo's got a really good cover. So these figures, I hope they're accurate to be honest with you, because as I said, depending on where you look, it actually changes. So most of the dividend covers I got from Dividend Max, CADIs I got from Dividend Max on another website, not too sure, but mostly from Dividend Max. 3-year dividends I got from Reuters. This I got from Reuters. Cash flow, payout ratios I got from Reuters, and I also got from Yahoo Finance. The reason for that, some of the figures in Reuters just didn't seem correct. I mean, I think Ashtead had the payout ratio of 4, and when I looked at Yahoo, I think that was reading 25. So I just went with 25 basically. Diageo, yeah, so that's a 7.9. Consistently pays, over 10 years, which is good for me. However, the dividend growth is not really that high, but it's something that's maintainable, or achievable rather, which is a 5%, BME is basically a 14% increase, so I mean that's looking good as well. They got a good payout ratio. They've been paying consistently for 6 months, BME, and they got good cover as well. So these are basically the kind of stuff I'm looking for. So I said I was going to talk about, so yeah, Helma, they payout ratio is super low, very cash flow positive. They basically, they increase it about 7% every year. And they've been doing that. They don't. Yeah, it's always been a constant 7%. So it's not really an average. Essentially, it was an average of 7%. So, but it's still 7%. And they've been doing that over the past 10 years, essentially. So it's one of those ones that as long as they keep on doing 7%, as long as they keep it to 7%, I think they'll be okay. I mean, the payout ratio is super low, and the dividend cover is 3.2, so that's pretty good. But if you can see, the yield is pretty low, and the payouts isn't really that high. The annual dividends isn't the highest, but as I said, it's going to be growing over the next couple of years. This is one I definitely expect to grow on a yearly basis. And I think most of these dividends as well, most of these companies didn't cut dividends this year. I think JW did, and I think that was it actually. All your other companies basically pay dividends. I'm not sure about Softcat. I just added that one, and LSC, I'm not sure about them as well. But all the other and Sage Group, I'm not sure about them as well. But I think all the other companies basically pay dividends this year, so that's looking good. So this is basically how I try. I'm not going to go too much into any more detail about this. I think, these Polymetal International and Rio Tinto, they're growing. I think these companies usually just kind of have a high dividend payout ratio, essentially. It's not really a problem for me. At the end of the day, they do pay pretty good dividends, and Rio Tinto, that's pretty good. So I'm happy with that. If they can sustain it, then that's fine by me as well. I'm not too worried about that. So so just have a look at it and see. You'll see if essentially this makes sense to you. If you have any questions, just kind of let me know, and I'll answer your questions. But this is how it should be a dark green. This is basically how I assess my dividend growth stocks from dividend growth risk analysis, basically, and also with a bit of common sense as well, because sometimes these things might be a bit misleading, like GSK. Okay. So next is just dividend growth bit we've talked about. So I'll be getting monthly payments. I think September is probably going to be my best month out of the year, so you shall be seeing what I get then. This needs to be updated essentially because I added some new stocks. So I said I had Siemens before, but I've removed that. So essentially just going to be capturing dividend payments, and the totals will be recorded here. And so I think this is for, like, if you fill in the figure, press enter, kind of shows it on this graph essentially, so you can kind of track your dividend growth over the next couple of years essentially. So that's that. So that's that for this actual spreadsheet, I believe. There's really nothing else to talk about. Every month I just try and put in a bit of money. I aim for £300. If I can't get £300, then I just try and put in what I can, basically, and kind of grow the portfolio or the F.I.R.E portfolio over time. So I don't really plan on adding any more stocks, to be honest with you. I'm pretty content with these stocks. I have changed them a bit over the past couple of days, and this actually took me a while to do. this is taking me close to about 3 days basically to analyze and to get all this information in. And yeah, I just thought I would share that with you. Yeah, once again, thanks for subscribing. Thanks for liking the videos. Thanks for commenting as well. And yeah, obviously, I'm going to be leaving Freetrade 212 link. If you would like to join Freetrade, we can go both get by using that link. Essentially, we'll both be getting some free shares. So yeah, I think that's it for me. So everyone, take care and stay blessed. Okay, all right, bye.